Disclaimer.
Hi, it's AG. You know the guy who brings the latest financial news every morning. I'm also bringing you a big smile because what you're about to discover is excellent. It's Monday morning, January 26th, and the global financial plumbing has just burst. While America slept, gold surged to $5,085 and silver rocketed to $107.54 in overnight trading. The triple-digit silver era isn't coming, it's here. But don't be fooled by the number on your screen. This isn't just a rally. What we're watching in the Asian sessions is a total physical decoupling. As President Trump's latest tariff threats ignite a global de-dollarization panic, the spread between paper promises and physical metal has widened into a canyon. The DOJ's criminal probe into Jerome Powell has paralyzed the Fed's ability to stabilize the dollar, leaving Comex completely exposed. As the New York bells ring, thousands of shorts are facing a margin call that's mathematically impossible to meet. Registered inventories are at terminal lows, and for the first time in history, the question isn't what is the price, it's who actually has the bars. Today, we aren't looking at charts. We're looking at delivery notices. Let me put this in perspective for you. For the past 50 years, the price of gold has been determined in New York and London. Our futures exchanges set the price that the rest of the world accepted. That system just broke at 1:06 a.m. New York time. Shanghai and Hong Kong spot markets pushed gold through $5,000 and kept driving while our traders slept and our exchanges sat frozen. These aren't normal moves. These are the kind of surges that signal something fundamental has shifted in the global financial architecture. Here's what should grab your attention about the timing. Trump dropped a bombshell on Saturday that most Americans missed while scrolling through their weekend social media feeds. He threatened Canada with 100% tariffs if Prime Minister Mark Carney finalizes a trade deal with China. We're not talking about some minor trade dispute over softwood lumber. We're talking about 49,000 Chinese electric vehicles heading to Canada in exchange for reduced tariffs on Canadian canola exports to Beijing. Think about what that means for our economy. Canada is our largest trading partner. We share a 5,500-mile border, integrated supply chains, and energy infrastructure that keeps our lights on and our factories running. Now imagine that relationship fracturing because Carney is making side deals with the very country we're trying to economically contain. You're watching a three-way trade war explode between North America's biggest partners, and gold figured it out before the Sunday morning talk shows even addressed it. Asian markets reacted first because they were open when the news broke. But here's the deeper revelation that changes everything you thought you knew about precious metals pricing. For decades, when gold started moving up too fast, our futures exchanges had a reliable playbook. Print more paper contracts, increase margin requirements, coordinate selling between major banks to create the appearance of weakness. The physical market would eventually follow the paper price down because New York and London controlled the perception of value. That mechanism just failed spectacularly. Asian buyers wanted physical metal, not paper promises. Shanghai spot prices diverged from Comex futures by the widest margin we've seen since the exchange opened in 1877. When Chinese buyers bid gold to $5,085, they weren't trading contracts they could sell next week. They were taking delivery of actual bars they're moving into sovereign vaults. You might be wondering why this matters to your retirement account or your family's financial security. Let me connect the dots for you. When price discovery moves from west to east, it means the paper gold machine that has suppressed prices for your entire adult life is losing its grip. Every time you heard financial advisors say gold was overvalued or approaching a top, they were looking at Comex futures prices, numbers that could be manipulated by printing unlimited paper contracts. Physical gold doesn't work that way. You can't print more gold bars in Shanghai the way you can print futures contracts in New York. The Asian markets that drove this overnight surge deal in real metal with real settlement. When they decided gold was worth $5,085, they backed it up by paying that price in cash and taking possession of actual ounces. In 30 minutes, Comex opens and faces a choice that will define precious metals markets for the next decade. Our exchanges can accept that $5,085 is the new floor, validating that Asia now sets the price and New York follows. Or they can attempt an emergency suppression move using margin hikes and coordinated selling. But here's the problem. The traditional playbook is broken. The Fed can't raise rates to strengthen the dollar and crush gold because Powell is fighting criminal subpoenas. He's frozen, unable to act without appearing to cave to presidential blackmail. Gold is breaking out precisely because the usual suppression mechanism has been neutralized. Silver's surge to 107.54 confirms this isn't isolated to gold. When industrial buyers in Asia are also front-running a currency crisis, converting dollars into tangible assets, you know the smart money sees what's coming. December saw 115.1 tons of physical gold deliveries against Comex contracts, 6.8% of open interest versus the historical average below 1%. When Wells Fargo absorbed $187 million in a single day buying actual metal rather than rolling contracts forward, They signaled that big institutional money wants possession, not promises. At 8:20 this morning, when Comex opens, you'll see in real time whether Western price control still exists. If gold holds above 5,050 in the first 30 minutes, the Asian price stuck, and you're watching history. If it dumps below 49.50, they executed one final coordinated smash. But the critical question becomes, how many more times can they pull that off when physical demand is draining registered vaults? The overnight breakout wasn't random. It was Asian markets pricing. In a world where American financial hegemony no longer guarantees dollar stability, they're voting with real money, moving real metal, and setting real prices while our markets sleep. In 30 minutes, we find out whether New York still has the firepower to fight back, or if the gold market permanently moved east overnight. You need to understand what happened on January 10th that broke the back of dollar credibility. The Department of Justice served Jerome Powell with grand jury subpoenas threatening criminal indictment over his Senate testimony about $2.5 billion in Federal Reserve renovation costs. Let that sink in for a moment. The President of the United States weaponized the Justice Department against the Chairman of the Federal Reserve, the one institution that's supposed to operate independently from political pressure. Powell called it unprecedented intimidation designed to force rate cuts. Trump wants rates at zero to juice the economy before the next election cycle. But here's the trap Powell found himself in. If he cuts rates now, he proves that Trump's blackmail works. If he holds rates steady, he faces potential criminal prosecution. And if he raises rates to defend the dollar against this gold surge, he looks like he's deliberately sabotaging the economy out of spite. So Powell did the only thing he could do. He froze. The Fed hasn't made a meaningful policy move since that subpoena landed, and global markets noticed immediately. Gold jumped 17.36% in 30 days between December 26th and January 26th. That's not a normal move. That's panic buying by people who understand what it means when America criminalizes its own central bank chairman. Think about what this looks like from Beijing's perspective, or New Delhi's, or Riyadh's. For 50 years, the dollar's credibility rested on one fundamental promise. The Federal Reserve operates independently from political interference. That independence meant the Fed would fight inflation even if politicians hated it, defend the dollar even if it hurt the stock market, and maintain monetary stability even when presidents demanded otherwise. That promise just died in front of the entire world. When Trump's DOJ threatened Powell with prison for testifying to Congress for literally doing his job, every foreign central bank holding dollar reserves asked the same question. If America's Fed chairman can be indicted for telling the truth, what's our dollar exposure actually worth? Here's what makes this moment uniquely dangerous. Powell wasn't caught in some financial scandal. He wasn't accused of insider trading or corruption. The DOJ is investigating him for explaining to senators that the Federal Reserve building renovations cost $2.5 billion. That's it. He told Congress a factual number about construction costs, and now he's facing potential criminal charges because that number embarrassed the administration. Think about the precedent this sets. If a Fed chairman can be criminally prosecuted for transparent testimony to Congress, then every future Fed chair knows they serve at the President A's pleasure, regardless of what the law says about independence. The 14-year term that was supposed to insulate them from political pressure becomes meaningless when the Justice Department can manufacture investigations over truthful testimony. Republican Senator Tom Tillis made the situation even clearer on January 11th when he publicly stated he'll block any Fed nominee until this investigation ends. Think through the implications of that statement. It means Powell stays through 2028, not just May 2026 when his term officially expires. Trump can't install his puppet, the Senate won't confirm a replacement, and the world just watched America's political system completely paralyze its central bank. But here's the part that should terrify anyone holding dollar-denominated assets. Tillis isn't defending Powell because he likes the Fed chairman's policies. He's defending Powell because even Republican senators understand that once you destroy Fed independence, the dollar becomes just another political currency subject to whoever controls the White House. And if the dollar is just another political currency, why would China or Saudi Arabia or Japan hold trillions of them? This is why Asian central banks accelerated gold buying to 60 tons per month versus 17 tons before 2022. That's a 353% increase in physical accumulation happening immediately after the Powell subpoena. These aren't retail investors panic buying coins from their local dealers. These are sovereign nations converting dollar reserves into gold bars at a pace that would have been unthinkable 5 years ago. According to the World Gold Council, central bank gold purchases hit 1,037 tons in 2024, shattering the previous record of 1,082 tons set in 2022. But January 2026's pace is running even hotter. We're tracking toward 1,400 tons for the full year if current buying continues. These institutions don't make impulsive decisions. They're not chasing momentum or reading technical charts. They're responding to a fundamental break in the system that's backed global trade since 1971. Let me give you concrete examples of what this looks like on the ground. The People's Bank of China reported adding 39 tons to reserves in December alone. India's central bank purchased 17 tons in the same month. Turkey bought 22 tons. Poland acquired 19 tons. Singapore, which rarely discloses gold purchases, confirmed through customs data that they imported 43 tons in the fourth quarter, their largest quarterly intake since records began. These aren't random countries making isolated decisions. This is coordinated diversification by nations that watched Powell get served with criminal subpoenas and concluded that dollar dependence is an existential risk. When America threatens to imprison its own Fed chairman for telling the truth, every finance minister on earth starts asking their staff, how fast can we reduce dollar exposure without crashing our own currency? Here's what you need to grasp about the 71 Nixon shock. When America abandoned the gold standard, we made a deal with the world. You'll hold dollars instead of gold, and in exchange, we promise the Federal Reserve will maintain purchasing power through sound monetary policy enforced by an independent central bank. Countries accepted that deal because Fed independence was credible. Volcker proved it in the 80s when he crushed inflation by raising rates to 20% despite massive political pressure. That credibility is what made the petrodollar work, what made treasury bonds the global safe asset, what allowed America to run trillion-dollar deficits without currency collapse. Foreign governments trusted that even if American politicians spent recklessly, the Fed would eventually clean up the mess and protect dollar holders. Now picture yourself as the finance minister of Singapore or the central bank governor of Poland. You're holding hundreds of billions in dollar reserves. You just watched the American president threaten to imprison the Fed chairman for testifying to Congress. Your staff brings you a memo showing that gold has gained 17% in 30 days while your dollar reserves lost purchasing power. What's your move? You can't dump all your dollars at once. That would crash your own currency and destroy the value of your remaining reserves. But you can start a quiet, systematic program of converting 10% of your dollar holdings into gold every quarter. That's exactly what we're seeing in central bank data. Not panic selling of dollars, but steady, relentless accumulation of gold that accelerated the moment Powell got subpoenaed. Mark Carney understood this perfectly when he spoke at Davos on January 20th. The former Bank of Canada governor, who's now advising the Canadian government on Trump's tariff threats, said we are in the midst of a rupture, not a transition. Those words were chosen carefully. A transition implies gradual change that both sides manage cooperatively. A rupture means something broke suddenly and violently, and you're scrambling to adapt to the new reality. Carney went further, stating that middle powers must act together against American coercion. That's diplomatic language for what's really happening. America's allies are coordinating a response to dollar weaponization. They're not forming a military alliance against us. They're building financial infrastructure that doesn't depend on dollar clearing, SWIFT transfers, or Federal Reserve cooperation. You saw the first concrete example of this coordination when Trump threatened Canada with 100% tariffs over the potential China trade deal. 49,000 Chinese electric vehicles heading to Canada in exchange for reduced canola tariffs does not sound like much until you understand the strategic implications. Canada is our largest trading partner. We do $750 billion in annual trade across a 5,500-mile border. Our supply chains are integrated to the point where auto parts cross that border 7 times during manufacturing. And Trump just threatened to cut that relationship in half over a side deal with Beijing that represents less than 1% of Canada as total trade. The economics of that threat don't make sense unless you understand it as part of a larger pattern. Trump isn't just fighting China, he's fighting anyone who tries to build trade relationships that bypass American approval. The tariff threat against Canada is about forcing compliance, demonstrating that proximity and alliance don't protect you from economic coercion if you step out of line. But here's what Trump missed in that calculation. Every time America weaponizes the dollar or threatens its closest allies with economic destruction, we accelerate the very de-dollarization we're trying to prevent. Canada isn't going to cancel the China deal because Trump threatens tariffs. Canada is going to accelerate plans to trade in yuan, euros, and gold because the threat proved that dollar dependence is a vulnerability that can be exploited at any moment. Gold jumped 4.3% the morning after Trump's Canada threat, not because investors feared tariffs on maple syrup. Gold jumped because the threat revealed how far America is willing to go to maintain dollar hegemony, and how that desperation is driving our traditional allies toward alternatives. When your biggest trading partner threatens you with economic nuclear war for diversifying your export markets, the logical response isn't submission. It's reducing exposure to that partner's currency as fast as possible without triggering retaliation. Federal Reserve data shows this happening in real time through the Treasury International Capital Flows report. Foreign official holdings of Treasury securities dropped by $118 billion in the fourth quarter of 2025. That's not normal portfolio rebalancing. That's central banks actively reducing dollar exposure while gold prices surge. They're voting with their reserves, and the vote is clear. American financial hegemony backed by a criminally threatened Fed chairman is not a bet they're willing to make anymore. The Bank for International Settlements reported in their January quarterly review that gold's share of global reserves reached 15% for the first time since the 90s. That percentage might not sound dramatic until you realize it represents $1 trillion in capital allocation away from dollars and toward physical metal. Every percentage point shift at that scale means fewer treasury buyers, higher yields America must pay to finance deficits, and more pressure on dollar exchange rates. Let me translate that into terms that affect your retirement account and your mortgage payment. When foreign central banks buy fewer treasuries, the U.S. government must offer higher interest rates to attract buyers. Higher treasury yields mean higher mortgage rates, higher car loan rates, higher corporate borrowing costs. Your 30-year mortgage rate that was 3% in 2021 is now 7.2%. And it's heading higher unless we can convince foreign buyers to come back. But why would they come back when Powell is facing criminal prosecution and Trump is threatening our closest allies with economic destruction? The rational move for any foreign finance minister is to continue diversifying away from dollars into assets that can't be weaponized, frozen, or inflated away through political pressure. That's gold, and increasingly, it's bilateral trade agreements that bypass the dollar entirely. You're watching a feedback loop that's impossible to stop once it starts. Political pressure on Powell makes the Fed less credible. Reduced Fed credibility drives gold higher and dollar demand lower. Lower dollar demand forces America to either raise rates dramatically to attract buyers or accept currency depreciation. But raising rates would crash markets and verify Trump's accusation that Powell is sabotaging the economy. So Powell stays frozen, and the feedback loop accelerates every single day. This is why gold isn't just making new highs. It's breaking out in a way that suggests we are repricing the dollar's role in the global system. $5,085 isn't expensive if you believe the Fed can no longer defend purchasing power. $107 for silver is on a bubble if you think dollar-denominated contracts might not settle in physical metal during the next crisis. Smart money figured this out weeks ago when Wells Fargo started taking delivery instead of rolling contracts forward. They absorbed $187 million in a single day buying actual metal rather than paper contracts. They're not betting on higher gold prices. They're buying insurance against a system where paper claims to gold might not convert to actual bars when everyone tries to exit at once. That's the kind of positioning you do when you believe Comex faces a potential delivery default, not when you're speculating on price moves. The math here is straightforward but terrifying for anyone short precious metals. Comex has roughly 850 tons of registered gold inventory available for delivery. That sounds like a lot until you realize global mine production is around 3,200 tons per year, and central banks are buying 1,400 tons annually at current pace. If just 5% of paper gold contracts demanded physical settlement simultaneously, a completely plausible scenario of confidence breaks, Comex inventories would be exhausted in weeks, not months. Silver's situation is even more precarious. Industrial demand from solar panels, electronics, and green energy consumes 60% of annual mine supply. Investment demand takes another chunk. What's left for Comex delivery is measured in millions of ounces when the exchange has open interest representing billions of ounces in paper claims. The ratio of paper silver to physical silver available for delivery is somewhere north of 100 to 1. You don't need a complete loss of confidence to break that system. You just need enough contract holders to demand delivery that registered inventories can't cover the demand. That's when Comex would be forced into cash settlement, paying dollars instead of metal. And the day that happens, the paper price and physical price decouple permanently because everyone holding contracts realizes they are worthless in a crisis. This is what Asian markets priced in overnight while America slept. They looked at Powell facing criminal prosecution, Trump threatening Canada with 100% tariffs, Comex inventories at terminal lows, and they concluded the probability of forced cash settlement just went from theoretical to realistic. So they bid gold to $5,085 and silver to $107.54. Because in a world where paper contracts might not convert to metal, physical possession is worth a massive premium. The premium between physical gold coins and paper contracts is already signaling stress. American gold eagles are trading at $90 over spot price. Canadian maple leafs command $85 premium. 1 ounce bars show $60 spreads. Those premiums were $15 to $20 just 6 months ago. The physical market is telling you that people with actual metal are demanding huge premiums to part with it because they understand something the paper traders haven't figured out yet. When the spread between physical and paper widens to this degree, it means one of two things. Either physical holders are irrational and leaving money on the table by not selling to capture premiums, or they know something about coming delivery problems that makes holding physical worth far more than current spot prices suggest. Given that we're talking about central banks and institutional buyers driving this premium expansion, I'm betting on the second explanation. In 20 minutes, Comex opens and American traders see these prices for the first time. The shorts, who sold contracts at $4,800, now face margin calls at $5,085. Some of them can meet those calls, some of them will have to cover by buying back contracts at a loss, and some of them might try to deliver physical metal they don't actually have in their vaults. That last group is about to discover what happens when paper promises meet physical reality. In less than 30 minutes, the opening bell rings at Comex, and American traders face a decision that will define the precious metals market for the next decade. They're staring at gold priced at $5,085 and silver at $107.54, both set overnight in Asian markets while New York slept. The question isn't whether these prices are justified. The question is whether Comex has any choice but to accept them. Here's the brutal arithmetic that's keeping bullion bank traders awake right now. December's delivery data showed 115.1 tons of physical gold demanded against contracts. That's 6.8% of open interest actually converting to metal versus the historical average of less than 1%. Comex was designed as a paper trading platform where 99% of contracts settle in cash. When 7% demand physical delivery, the system starts showing cracks. When that percentage doubles or triples, the system breaks entirely. Let me walk you through what happens at 8:20 this morning in terms you can visualize. Picture a trader at one of the major bullion banks sitting at their desk in lower Manhattan. They sold gold contracts at $4,800 3 weeks ago, collecting premiums and betting the price would drop so they could buy back cheaper and pocket the difference. That's a standard short position that works great when you control the market. But overnight, gold gapped up to $5,085. Their broker just sent a margin call demanding they deposit an additional $285 per ounce in cash to maintain their short position. If they're short 1,000 contracts, representing 100,000 ounces, they need to come up with $28.5 million in cash by noon, or their position gets liquidated automatically. Now multiply that scenario across dozens of traders, hundreds of hedge funds, and thousands of individual short positions placed over the past month. You're looking at billions of dollars in margin calls hitting simultaneously at the Comex open. Some of those traders have the cash and will meet the margin. Some will be forced to cover by buying back their shorts at a massive loss, which pushes prices even higher. And some will try to deliver physical metal to close their positions. That last group faces a problem that's about to become very public. Comex registered vaults. The metal available for immediate delivery hold approximately 850 tons of gold. Sounds like plenty until you realize that if just 10% of current open interest demands delivery, you need over 1,000 tons. The metal doesn't exist in the vaults to cover a surge in delivery requests. This is where the Wells Fargo decision from 3 weeks ago becomes crucial intelligence. When a bank that size takes physical delivery of $187 million in gold rather than rolling contracts forward, they're telling the market they don't trust the system to deliver when it matters. Wells Fargo has inside knowledge of Comex inventory levels, delivery requests, and stress points. If they're pulling metal out of the system, they know something about coming delivery failures. Silver's situation is exponentially more dangerous. Industrial users need physical silver for solar panels, electronics, medical devices, and green energy applications. Unlike gold, which mostly sits in vaults, 60% of silver gets consumed every year in industrial processes. You can't make solar panels with silver futures contracts. You need actual metal delivered to factories in China, Germany, and Texas. Current Comex silver inventories show roughly 300 million ounces in registered vaults available for delivery. Open interest represents over 1 billion ounces in paper claims. That's a 3.3 to 1 leverage ratio on registered metal. And it gets worse when you factor in that much of that registered silver is already spoken for through existing delivery requests that haven't settled yet. Industrial buyers are watching silver hit $107.54 and doing math on their supply chains. If they need 10 million ounces for Q2 production and silver keeps climbing, do they wait for prices to drop, or do they lock in supply now before delivery premiums spike even higher? Every industrial buyer making the rational decision to secure physical supply ahead of production needs accelerates the drain on Comex inventories. The Friday Fed meeting on January 29th adds a deadline to this entire scenario. Powell has to either cut rates, hold steady, or raise them. Each option creates a different path for precious metals, but all roads lead higher from here. Let me break down the 3 scenarios and why gold wins regardless of Powell's decision. Scenario 1. Powell cuts rates to appease Trump and avoid further prosecution threats. The dollar weakens immediately as markets interpret the cut as Fed independence dying in real time. Gold explodes higher because if the Fed chairman can be bullied into cutting rates through criminal prosecution threats, what's to stop future presidents from forcing rate cuts every election cycle? That's Banana Republic monetary policy, and gold responds by pricing in permanent dollar debasement. Target, $6,000 by March. Scenario 2. Powell holds rates steady, maintaining the current freeze. This is the most likely outcome because it avoids the appearance of either caving to Trump or deliberately sabotaging the economy. But holding steady while gold breaks out and the dollar weakens accomplishes nothing except confirming the Fed is paralyzed. Gold continues climbing because the market realizes Powell can't defend the dollar without either looking political or facing intensified prosecution threats. Target, $5,400 by mid-February, exactly where Goldman Sachs just revised their price forecast. Scenario 3. Powell raises rates to defend the dollar and combat inflation from the gold surge. This would be the traditional response, but it's politically impossible right now. Raising rates crashes the stock market, hurts Trump's economic narrative, and proves every accusation that Powell is sabotaging the economy. Republicans would demand his immediate removal. Democrats would defend Fed independence but lose the political battle. Gold still wins because the rate hike would be seen as a desperate last stand by a Fed chairman with no political support, and markets would bet against Powell's ability to sustain higher rates under that pressure. Target, $5,200. As the floor with spikes to $5,800 during the political crisis. Do you see the trap Powell is in? Every path leads to higher gold prices because the market is no longer trading Fed policy. The market is trading Fed credibility, and that credibility died when the DOJ served criminal subpoenas. Here's what $5,400 means for your investment decisions. If gold is currently at $5,085 and the support level is $5,200 after a potential Comex smash today, you have an $885 downside buffer against an upside target of $315 by February and potentially $915 by summer if the political crisis escalates. That's a risk-reward ratio heavily skewed toward buying physical metal on any weakness. The 50-to-1 gold to silver ratio tells you where silver is heading. If gold hits $5,400, silver should trade at $108 just to maintain the historical ratio. But silver tends to outperform gold on the upside because of its smaller market size and industrial demand that can't be satisfied with paper contracts. When manufacturers need physical silver and premiums are spiking, they pay whatever it takes to secure supply. That's why $107.54 is the floor, not the ceiling. Asian markets already established that price overnight with physical buying. If Comex tries to smash silver back to 95, or 100 Asian buyers will absorb every ounce offered at those prices, because they know industrial demand will push prices higher, regardless of what paper traders do in New York. Your decision matrix at 8:20 this morning comes down to reading the first 30 minutes of trading. If gold holds above $5,050, meaning it only gives back $35 from the overnight high, the Asian price stuck. Comex traders are accepting that price discovery moved east, and New York is now a follower, not a leader. That's the moment you need to understand Western price control ended and a new era began. In that scenario, physical gold premiums spike within days as dealers realize inventory is scarce and buyers want possession before the premium gap widens further. American Gold Eagles already at $90 premiums could hit $150 over spot. 1 ounce bars that show $60 premiums today could push to $120. You'll be paying $5,300 to $5,400 for physical gold, even if paper contracts trade at $5,100, because the physical market will decouple from Comex pricing. If gold dumps below $49.50 in the opening 30 minutes, a $135 smash from overnight highs, you'll know they coordinated emergency measures. Margin hikes, coordinated selling by bullion banks, and possibly intervention by the Exchange Stabilization Fund to defend the dollar. That gives you one final entry point before the Friday Fed meeting forces Powell's hand. But here's the critical insight that separates winning this trade from getting trapped. A coordinated smash only works if Comex can deliver physical metal to the shorts, covering their positions. If registered inventories can't meet the delivery demand, the smash becomes the signal that the system is breaking. Smart money will buy the dip, knowing that forced cash settlement is inevitable within months. The whisper number, circulating among bullion dealers, is that registered gold inventories are already committed through existing delivery requests that haven't cleared yet. If that's true, and the Wells Fargo delivery suggests it might be, Comex doesn't have 850 tons available. They might have 400 tons or less that's actually unencumbered. At that inventory level, even a modest surge in delivery requests triggers a crisis. You saw a preview of this during the March 2020 COVID panic when gold futures briefly traded $40 below London spot prices, because Comex couldn't deliver physical metal to match contracts. The exchange was forced to accept London good delivery bars as settlement instead of Comex-approved bars because registered inventories were exhausted. They papered over that crisis by changing the rules, but it exposed the fundamental weakness in the paper trading system. This time, the crisis isn't a temporary COVID disruption. This is structural, driven by central banks systematically converting dollar reserves to gold, industrial buyers securing silver supply ahead of production needs, and institutional investors like Wells Fargo taking delivery because they don't trust future settlement. You can't fix a structural crisis by changing margin requirements or adjusting delivery specifications. You either supply physical metal or you admit the system is broken. The BRICS Summit in August 2026 is the deadline everyone in the gold market is watching. Brazil, Russia, India, China, and South Africa, representing over 40% of global GDP, are meeting to discuss alternatives to dollar-based trade settlement. The rumors circulating through diplomatic channels suggest they're developing a gold-backed trade settlement system where bilateral trade imbalances clear in physical gold rather than dollars. If that system launches, demand for physical gold explodes overnight as these nations need to hold inventory for trade settlement. China alone does over $2 trillion in annual trade with BRICS partners. If even 10% of that trade clears in gold, they need an additional 6,000 tons just for working inventory. That metal has to come from somewhere, and the obvious source is converting dollar reserves held by their central banks. Mark Carney's Davos comment about middle powers acting together against American coercion makes perfect sense in this context. Canada, Australia, South Korea, and the European Union aren't joining BRICS, but they're watching closely to see if gold-backed trade settlement works. If it does, they'll develop parallel systems that reduce dollar dependence without formally opposing American interests. You're looking at a world where the dollar remains important for some transactions, but loses its monopoly on international trade settlement. That's the rupture Carney described. Not a transition to a new reserve currency, but a fragmentation where multiple settlement systems coexist, and gold serves as the universal fallback when trading partners don't trust each other's currencies. In that world, gold at $5,085 is cheap. In that world, central banks need multiples of their current gold holdings just to facilitate trade. In that world, Comex registered inventories of 850 tons represent less than 1 day of global trade settlement if the system fully pivots to gold backing. The 30-minute window starting at 8:20 this morning tells you if we're moving toward that world faster than anyone expected, or if the old system has one more fight left in it. Either way, the trend is clear. Physical metal in your possession is worth more than paper claims on metal that might not deliver when you need it. Asian markets already voted by pushing gold to $5,085 overnight. In 30 minutes, New York either accepts that vote or attempts to override it. But even if they smash prices today, Friday's Fed meeting forces Powell to choose between his independence and his freedom. And when that choice becomes public, the gold market is going to price in a world where the Federal Reserve serves at presidential pleasure rather than defending dollar credibility. That's not a world where gold trades at $5,000. That's a world where $6,000 becomes the new floor and $10,000 becomes the ultimate target, as the global monetary system reprices around the reality that American financial hegemony is ending, not with a bang, but with a subpoena. The opening bell is about to ring. Watch the first 30 minutes. Everything you need to know about the next decade of precious metals is about to be revealed.